Hi, I'm George Sandmann. I'm the founder and CEO of Growth Drive. I'm a Forbes published author about getting businesses unstuck and maximizing growth. And today I'd like to talk to you about fractional CFOs. If you're trying to grow profits and value, there are a few things you might consider. And here's why a CFO delivers a huge ROI. Now, I've been fortunate enough 30 plus years as an entrepreneur, 12 years working with senior level advisors, including fractional CFOs. We've performed over 50,000 CEO interviews. And what did we learn? We learned that of you and your colleagues, 62% of the time you want to grow revenue, 21% of the time you want to make your business easier to run, and 17% of the time you're preparing your business to sell, only to find out 83% of the time that the business can't deliver to you the value you need to fund your personal wealth plan. Now, that learning, that data led me to describe the three dimensions of business growth. And these probably resonate with you, right? Let's start with the first dimension. It's in the lower left circle. The first dimension of growth, and they're dimensions because you can move in all three at the same time. Happy news. The first dimension of growth is predictable profits and cash flow. And by having predictable profits and cash flow, you think about it, that's a business that's easier to run. That also provides a launch pad for growth. You know how much money you will have to invest tomorrow in machines, people, marketing, etc. We harness that to create predictable, sustainable growth. Lower right hand. Predictable, sustainable growth. That goes to that number one CEO goal. And maybe that's you. Now, the reality is this is where you live. You live in the world of cash flow. You live in the world of growth. And we're CEOs, right? We have a growth reflex. It's kind of how we're wired. But that doesn't mean that our business has value. And this is where a fractional CFO is especially important. How do you move in that third dimension of growth, which is predictable, transferable value? We'll get into that in detail. But these are the three dimensions of growth. And ask yourself, which of these is most important to you today? And which of these will be incredibly important to you tomorrow? And we're CEOs, right? We're competitive. We're smart people. We understand our business, our industry. We have friends who have sold businesses, raised capital, some of them successfully, some of them with some heartache. But let's take a business that was generating $1.7 million of net income, or EBITDA. And here's how this plays out in the market. Now, 19 out of 20, you can go into ChatGPT and check this out. 19 out of 20 companies cannot successfully complete an M&A transaction as it's currently run. 19 out of 20. Statistically, this is you. The businesses that can successfully transfer are sharing the range of multiples. And let's say for a manufacturing business, that range of multiples is 2 times earnings to 6 times earnings. Now, this business can trade at 2 times earnings, which means it's worth $3.4 million after paying the accountants, the lawyers, and the bankers. That $3.4 million is not going to deliver a lot of wealth. Did you know that by only doubling your net income, but by increasing the strategic capacity of your business, you can move your value from 3.4 million to 20 million? And that's not magic. That is the power of the multiple, the power of increasing strategic capacity. So if you want to learn more about it, understand it, and make your capacity actionable, make the value of your business actionable, talk to someone like a fractional CFO. They'll be able to show you what, where, and how. Okay? Now, your fractional CFO, what do? They make sure that your money is wired tight, your cash is wired tight, and that your future cash needs, capital needs, are known, understood. They're accountable for accurate and timely reporting on performance and on capitalization. And if that's not something you're looking at today, ask yourself why not and what it might do for you. And did you know that getting a high value really depends on buyer confidence in your financial reporting and in your projections, in the future performance of your business? You know, Warren Buffett says it best. He says, equity buyers do not care about yesterday's performance. They care about tomorrow's. And if you can't create high confidence in tomorrow's performance for your business, then you are going to have a hard time getting a top multiple and successfully completing an M&A transaction. You need help executing your strategic intent. Strategic intent is simply where you want to take the business. Now, CFO top 5, quick and dirty, cash flow management, financial reporting. Now, those are looking in the rearview mirror and making sure that sort of short-term needs are met. But budgeting and forecasting, as you grow a business, you start burning cash, and having accurate forecasts, sticking with the budget, and having actuals that come in at your forecasted is very important. Also very important at the deal table to push across and say, hey, we're really good. We got great processes, and we can have confidence. CFO helps you with investment decisions. Should we buy the machine? Should we lease the machine? Et cetera, et cetera. Cost management, increasing efficiency, making sure that you are getting the maximum return, that your people are productive and loyal. And as a bonus, a CFO can deliver powerful support in strategic planning because they're experts at creating predictive models about growth and profitability. So ask yourself, are you getting this kind of information? Can you coach up somebody who's on your team to generate this information? Or might you bring in a fractional CFO to generate this information and perhaps teach someone on your existing team how to do it going forward? Fractional CFOs are incredible resources for getting this stuff done. So how does the CFO play out in the 3 dimensions of business growth? Let's take a look at it. The 3 dimensions of growth is a methodology inside which there are 3 sets of 8 growth driving objectives, 24 in total. And of those 24, you, the CEO, are primarily accountable for 7 of them. Primarily accountable meaning if more than one person is accountable, no one's accountable, right? So you are primarily accountable for 7. That's a topic for another day. A CFO is also accountable for 7. And then your chief operating officer and your chief revenue officer would be accountable for 5 each. What are these for the CFO? Margins, financial reporting, understanding your market size, budgets, forecasting, having a history, right? A binder full of accurate and credible reports, understanding your growth compared to the market, and having data on your market share. And think about what you could do with everything that we just described, right? Now, how do we measure all of this? Well, a CFO brings powerful tools. Some of those are going to be as simple as Excel models. Others of these are going to be sophisticated software and systems that they bring to bear. And let's focus on one leading example, and that's Clarity. That's from my company, Growth Drive. Clarity is a tool that business advisors, fractional CFOs can bring that can really help you demystify what needs to get done to move your company from where it is today to where you want it to be tomorrow. Now, inside a tool like this, there are surveys, questions. We've got to gather data. And here's how it plays out for the fractional CFO. They have a couple of accountabilities in the first dimension of growth, 2 more in the second dimension. And now we think about the strategic nature. Anyone with a C in front of their name is a strategic player. If they are not helping you execute strategy, deliver on your strategic intent, ask yourself, why not? And if you need some more help, maybe they need to be coached up. Third dimension, this is predictable, transferable value. The CFO takes an even larger role with 3 primary accountabilities. All right. Now, how do you know if a CFO is doing well? What if you could score them? What if they had a scorecard? You can tell if you're getting increased efficiency or you're getting better reports. But what if you had a scorecard and you could go and look inside a tool and say, all right, here is the score. Here's how we're doing. We're measuring ourselves against best practices. We're measuring ourselves against the market about how the private capital markets would see the business. And here are the scores. Here are a couple of them in that first dimension again for the CFO. So you can always tell if you're getting an ROI in addition to margin, cash flow, et cetera, feeling better, sleeping well at night. But in terms of actual performance, you have a score. So, I mentioned that the fractional CFO is primarily accountable for 7 growth driving objectives, as are you. You have a different set. But they're also collaboratively accountable for other. And you think of these growth driving objectives as gears inside your business's engine. You have primary accountability, but we all need help. We're a team, right? And teams collaborate. So the CFO is also going to help the chief revenue officer, generate high recurring revenues. They're going to help you with strategic vision, strategic planning, executing that plan. And if you're approaching an M&A transaction in that third dimension, helping you write the business's story in words and numbers to today and for tomorrow, projections going into the future. Critically important for creating that high buyer confidence that generates a top price. Other things that you may or may not be doing today is benchmarking your growth. How's your business growing? How do you compare to inflation? And how do you compare to the industry? Profitability this year, last year, 2 years ago. Profitability of the industry. This business has a tremendous story. But I will say this, you better get a fractional CFO, because if this type of performance is outstanding, but it is also going to invite very careful scrutiny by a buyer. And you only get one chance to make a good first impression. Your CFO can also say, let's see how these scenarios play out. If we grow at X or Y rate, what impact is that going to have on the value of our business down the road? What might we expect? Where should we focus? This type of modeling is incredibly valuable for you as you decide the future of your business. And frankly, the future of your business is the future of your family and of your stakeholders, your suppliers, your distributors. Okay. What are your key takeaways here? A fractional CFO is a number predictor. They're not only making sure that the rearview mirror is very clear, but that the future is very clear from a financial perspective. They're critical for creating predictable profits, sustainable growth, and maximizing transferable value. Their accountabilities are very well defined. They deliver a high ROI. And as a CEO, don't you want to know how much cash you're going to have and when, so that you can plan the future? And piece of advice, don't even think about approaching an M&A transaction without the help of a CFO. So fractional CFOs are a great resource, very cost-effective way of getting this expertise into your business. You can sit down, have a free consultation, and see if they're going to help you get where you want to go. I hope you got value out of this presentation, and we wish you all the luck in the world. You are the power behind our nation's economy, and we want to help you succeed. Be well.